For decades, the stock market had a strict cover charge. If you didn't have thousands of dollars ready to deploy, you were effectively locked out. Waiting on the sidelines while you save up a huge lump sum costs you the most valuable financial asset you have: time in the market. Every year you wait is a year of compound interest you can never get back. But by 2026, the financial barrier to entry has officially dropped. You can now start investing with a single dollar. This extreme accessibility is great for building early habits, but it also exposes tiny portfolios to unique mathematical vulnerabilities. For any beginner looking to put their pocket change to work, the wrong platform can quietly wipe out your entire principal before you even see a return. We are currently seeing a massive rise in gamified micro-investing apps. These platforms heavily market the ability to build wealth painlessly through spare change roundups from your daily debit card purchases. They successfully target beginners because they completely remove the psychological friction and intimidation of traditional investing. You link a bank account, and the app does the rest. That frictionless convenience is funded by flat monthly subscription fees, typically ranging from $3 to $9. Contrast this immediately with traditional zero-commission brokerages. They require a few more minutes of initial setup, but they charge absolutely zero monthly maintenance fees. The heavily advertised effortless path of micro-apps comes with a structural cost that actively punishes the exact small-dollar investors it claims to help. This graph shows exactly how a seemingly harmless flat fee impacts a small starting balance over 12 months. Let's look at a specific realistic scenario. A beginner invests $50 using a micro app that charges a standard $3 monthly fee. That fee adds up to an annual cost of $36 just to maintain a $50 principal investment. Mathematically, this specific fee structure represents a staggering 72% negative yield on your money. Even in a historic bull market, your portfolio is bleeding out. The alternative is the fee structure used by traditional funds, known as an expense ratio. An expense ratio is a tiny percentage taken from the total investment, rather than a flat dollar amount. Flat subscription fees act as a massive drag on small portfolios, guaranteeing that the investor loses money, even during a historic bull market. We need to shift focus to the mathematically superior alternative: opening an account at a zero-commission broker like Fidelity, Schwab, or Robinhood. These platforms utilize fractional shares, portions of a full share, to allow beginners to buy slices of premium, low-cost index ETFs with just a few dollars. An ETF, or exchange-traded fund, is an investment fund that tracks a specific index and trades like a stock. This matrix shows a direct comparison of the cost structures. On the left, you have the micro-app's flat fee. On the right, the zero-fee brokerage relies solely on the ETF's microscopic expense ratio, typically around 0.03. The behavioral flaw in the logic is that it results in highly variable, unpredictable monthly investments. Your wealth building relies entirely on your rate of consumption. There is a historically proven superior wealth building system: dollar cost averaging, or DCA. DCA is an investment method where you regularly put the same amount of money into a chosen asset over time, regardless of market price movements. In this context, dollar cost averaging means setting up automated fixed weekly bank transfers of $5 or $10 directly to your brokerage account. You completely ignore the market's daily price. Executing a DCA strategy requires a one-time manual setup process and the psychological discipline to allocate your money intentionally. Deliberate, predictable portfolio growth will always outperform a passive strategy that relies on accidental spending to build wealth. This decision tree maps out your exact next steps. The correct platform is dictated entirely by your total portfolio size. If you are starting with under $1,000, you must avoid flat-fee micro-apps entirely. Follow this path to a zero-fee broker. For this lower bracket, pushing through the minor learning curve of a real brokerage is an absolute requirement to save your principal from fee drain. For investors scaling past $5,000 who require hands-off algorithmic portfolio rebalancing, robo-advisors or micro-apps become acceptable. At a $5,000 balance, a $3 monthly fee is mathematically diluted. It becomes a negligible percentage of the overall portfolio. A platform's viability depends entirely on how its fee structure scales against your current account balance. This checklist outlines a concrete, immediate action plan for anyone ready to start investing their first $100 today. Step 1. Open a free account at a major zero-commission broker that supports fractional shares, such as Fidelity, Robinhood, or Schwab. Step 2. Search for a broad market S&P 500 or total stock market ETF and purchase your first $10 fractional share. Step 3. Replicate the set it and forget it experience for free by automating a recurring $10 weekly deposit directly into that ETF. To actually succeed with small dollar investing, you must give up the gamified gimmicks and high-fee convenience in favor of intentional, mathematically sound wealth building.